Negociaciones. Edward Moya, market analyst at marketpulse and Oanda. Thank you so much for being once again in Negocios Televisión. Good afternoon.
Thank you for having me.
Edward, Janet Yellen seems desperate with the X date. She already said that the US will not be able to pay its debts the 1st of June. Reuters said today that Yellen has been meeting with Wall Street CEOs. Do you believe that she's trying to convince them to try to put pressure on the Republicans?
I think Janet Yellen knows that there's probably too much complacency right now with debt ceiling negotiations. There's this belief that everyone's going to wait till the very end and strike a last-minute deal, and I think that this time, though, considering the political backdrop, you're not going to get a united voice with Republicans. I think this is something where you need to see more aggressive steps taken early, and I think she's trying to put this country in a position where a meaningful deal can be reached, and not just a band-aid solution that leads to a much more tense moment during the summer.
If the Republicans don't lift the debt limit in the US?
I think that is a growing risk. I think most people don't have that as their base case scenario, but you're probably looking at an environment here where, the Speaker McCarthy is going to struggle to get Republicans to agree. I think, and he can't make any early concessions because he might anger that part of his base. And this is a very difficult environment. And I think that you're going to see some major struggles with getting a strong consensus amongst Republicans. And that's likely to lead to, I think, severe market stress when things get a lot more tense in credit markets.
Tomorrow, Edward, we have important data in the United States, CPI, inflation. Do you think we will be getting more disinflation in the United States tomorrow?
I think we're going to learn that inflation is proving to be a lot stickier than anyone has hoped. I think, inflation falling from 6% towards the 4%, area was a lot easier. And I think we're going to start to realize that it's going to be very hard to anticipate, steady downward movements in prices as we're starting to see some commodities are showing signs of life here. And I think, there's this expectation that, shelter prices are finally catching up, and we're going to start to see that reflect in the data. But I think other parts of inflation are starting to become a little bit more, upside risks are growing there, and this is probably going to complicate what the Fed does and has to signal. And I think higher for longer is probably going to be the ultimate takeaway, and that means all these Fed rate cut bets that are getting priced in right now, they're probably premature, and it's going to lead to some, I think, de-risking moments. So probably in the next few months.
Edward, which number are we going to see tomorrow in the CPI data?
Well, I think it's important to take a look at what's happening on the monthly side. I think you're going to start to see inflation is probably going to increase a little bit more noticeably. I think we're going to probably see a 0.4% on a monthly basis. I think the core readings are probably going to tick lower, but this is I think a very difficult environment for the Fed. I mean, the disinflation process is going to be very messy. I think you're not going to see, it's a one-way trade. I mean, we're seeing tremendous volatility with energy prices. I think we've seen almost a near 20%, $20 drop with WTI crude, and now prices are stabilizing. I think there's still, some upside risk for energy prices. I think you're probably going to see that this market is, looking at, abroad, and a lot of times China's, economic outlook has a great influence on inflationary pressures. They're not doing as well as we thought. So I think you're getting a lot of mixed signals, and I think there's still a lot of resilience in this economy, and that's what's probably keeping some of that pricing pressure, I think, skewed to the upside here. So I would not be surprised if we did get an inline or slightly harder than expected report.
We're almost finished with the earnings season in Wall Street. How did it go? Was it a positive surprise in Wall Street?
It was very surprising. I was so impressed with how, tech really outperformed. I think there's a lot of expectations here that we were going to see, the worst of the economy. We're going to see companies air out all their bad news, and that did not happen. I think we're really starting to get better signs here that this economy is a lot more resilient than we anticipated. I think there's been, tech has really led the way. A lot of companies are still able to have pricing power. Margins were a lot better than anticipated. I think this is what's driving some of those soft landing hopes. I think this is why the Fed is still a little bit upbeat here. It definitely did impress, and I think that we're probably going to start to see that as the economy figures out or starts to feel the true impact of this Fed rate hiking cycle. I think there's still downside risk for equities. I think everyone was short going into earnings season. Earnings impress. We stabilized, went higher, but it's hard to remain that upbeat, especially with all the risks that still remain on the table. I think that the markets are aggressively pricing in Fed rate cuts, and I think if that starts to not to play out, then I think you're probably going to start to see a very choppy stock market, if not potential some downside here, probably 5 to 10%.
Market analyst at marketpulse and Oanda, thank you so much.
Thank you for having me.
Bueno, y mientras tanto